Jason, I gotta say, I'm actually surprised we're pulling it together today. This was a lot there. Though I think that's becoming pattern for this show.
Yeah.
I want to thank everyone for joining us. My name is Corey Hoffstein. That very handsome gentleman on the screen next to me is the one and only Jason Buck. Behind the scenes, pulling the strings, orchestrating everything, is Jack Farley, who is unfortunately working out of a hotel room with very bad Wi-Fi, so he won't be in and out as he normally is, but we appreciate your time. This is Pirates of Finance, hosted on Blockworks. We're excited to have you here. Thank you, everyone. We're going to be talking a little bit about capitulation today, Jason. Markets were kind of ugly. We were scrambling for what to talk about because you were at permissionless all week. I've been very busy. I was actually just at the airport picking up my brother, who's come to visit me, and then I had to kick him out of my house so that I could do this show. That's how much I love everyone here. And while I think I was at the airport, Jack was like, so what are we actually talking about? And the market looked ugly. So I said, let's talk about capitulation. Like, everyone tries to bottom time. What does capitulation actually look like? Like, if you were building a checklist of things you see in a typical market capitulation, where are we at today? And I sent you a note that I had written some of my clients about maybe some of the things I would look at. So happy to talk from my side. But the nice thing about being the guy who does the intro is I get to ask the first question. So Jason, capitulation. If we're talking capitulation, like, did the market just make the bottom? What things are you typically looking for?
Yeah, well, first of all, I'm going to distract for a second and just shout out to the comments section. I thought Sean Weiland just timed his comment perfectly to be first. Should have put it in first instead of LFG, but appreciate the LFG, and Menachem was always right behind him as usual.
We got to shout out the comment section in our last video, which went full Goblin Town on us. You guys, listen, Jason said it best. Whenever we talk about macro on this show, it's like pure Rorschach test for our listeners, because we have every angle of macro mad at us, telling us we're wrong, which is the beautiful part, which means we clearly didn't say anything coherent.
Right.
Because everyone thinks, yeah, we did our job, I guess. Because no one on both sides of the aisle of macro beliefs thinks we know what we're talking about, which is true. We don't, to be clear, despite we're on a macro channel. Anyway, back to the topic at hand.
Yeah. So, well, capitulation for one, like, you and I have talked many times about the idea of, VIX is spot VIX is non-tradable, so it's not a good measure of volatility, even though it's called the fear index. But when, for example, when you see, vol at a 30 handle, that's not a capitulation kind of environment in general. You're not really seeing any sort of big movement on a vol. We've seen what I would consider an orderly sell-off this year. Even though we touched on, and you and I are keeping track, because this is going to be great to kind of for us and the audience to participate and follow along as we're at options expiration or OPEX today. A lot can happen in the markets. At one point, we were down 2% in the S&P 500 at different points this morning, and then we're going to see, as dealers try to maybe flatten out their deltas, are we going to have a face-ripping rally into the close today, or are we going to stay here, or are we going to sell off more? So it's going to be really interesting to see, but part of that capitulation, I think, is like when you see real fear, and maybe not fear necessarily measured by VIX, is that capitulation and that sell-off is not as orderly, right? You wrote a great paper called Liquidity Cascades, right? And I think that's some of the points we'll touch on. And I think you wrote a great email this morning that touched on more points that we'll discuss. But it's more of that, is like when you just have panic selling, like where it's just not, it's not kind of orderly throughout the day. And I think that's all we've seen this year, is like just this orderly sell-off, and it's been a grind down. And so I think another thing we frequently talk about, if you are to look at the VIX, a good heuristic is the rule of 16. So if you just take whatever the VIX handle is and divide by 16, that'll give you the expected implied volatility distribution for one day. So if the VIX is at 16, you would expect it to go up or down 1% a day. At 32, you're going to expect to go up or down 2% a day. So right now, if we're getting close to that 32 handle and the market's only down 1.5%, then volatility actually can come back in, because realized was less than implied. And that's what people sometimes are like, well, the S&P is down and VIX is down, the markets are broken. No, it's expected variance. And so if the variance is below what the expectation for variance is, you can have that kind of scenario with S&P down and VIX is down. And going in this year, that's kind of what we've seen, especially this month. We've seen larger moves, but most of the moves have been within that implied distribution or variance of the expectation of forward-looking volatility.
Yeah.
Hopefully I
So
didn't say too many
just to
buzzwords
cut
there.
you off. No,
Yeah,
to
please.
cut you off real quick, because I think you made a really good point about the nature of the moves themselves. Someone in the chat was asking, why isn't volatility responding? Our friend Ben Eifert had a tweet today where he said, if the market went down 1.5% per day every single day for the next 6 months, what would VIX be at the end? And the answer is, actually, I think it's kind of more complicated. But to your point, you could use that times 16 rule, and you'd be like, it's probably around 24, right? Because the market's going down 1.5% per day.
Yep.
And vol is going to therefore be around 24. I actually think there's a really subtle, weird derivatives case where you say, well, if you know it's going down 1.5% per day, that's no longer vol. That's now your risk neutral drift, and therefore vol has gone to zero. But either way, it shouldn't be higher, right? The only way it's going higher is if people are forced bidders on put protection and they're willing to buy above fair value because they have to. And that's typically what you see in a March 2020 environment. Is you have these structured products where people may be short puts within the structured products, and then all of a sudden they hit this knockout zone, and you get all of these banks that are bidders of these puts driving that value up. People are scrambling to buy protection at any cost. To your point about the grind down, yeah, we're in an environment where VIX shouldn't necessarily respond. We could drop 50 bips a day for the rest of the year, and vol would stay low in theory.
Right. Well,
the other,
hold on. Before you say for the rest of the year, I want to get into that. By the way, John asked, what's the drinking word for the day? Let's say volatility. So then everybody's just going to be hammered by the end.
Does vol count? Does implied vol? Does IV count? VIX?
Yeah, exactly. And I love they're calling us out already on my macro calls. Quote, we're going to go up, stay flat, or fall into the close. Bold macro call from Jason. Exactly. You gotta love my macro calls. But okay, but you said we could drip down for the rest of the year, and I think I'm curious your take on this, because I don't think that's necessarily mathematically possible. So, for example, I also want to give historical precedents. We saw a lot of this in Q4 of 2018, if I recall correct, especially in December's, where it was an orderly sell-off of like 50 bips a day. So you didn't really see a pop in volatility. But to your point is, if realized is always grinding down less than implied, eventually implied comes down. And it's just how much time does that take before then any sort of pop in realized will spike implied back up. So I don't think you could do it through a rest of the year. You might be able to do it for a week, a month, potentially a quarter, but you're not going to necessarily see that going for a year.
I was talking pure theoretical exercise here.
All
just to be clear, this is what markets are going to do, is pure theoretical exercise. But I think the other important point, and this ties to some of, you mentioned my liquidity cascades work. I think one of the things that we have seen is that protection has been bid as people are coming out of 2020, that big volatility sellers got washed out. So you don't have necessarily the same volatility selling, and a lot more people migrated to volatility buying strategies, or they're buying downside protection. A very simple example here is you look at like the JP Morgan hedged equity fund that is now like $15 billion, where pre-pandemic it was $1 billion. People are running to tail hedging strategies, looking to adopt put protection. And so that means those puts are generally bid. And there's, in my opinion, like the way to think about when those puts pay off is what's going into pricing those puts. And I think of this a lot like insurance on your house. Like
this is a great analogy you came up with today. I'm so excited for this. I've reading it. I was like, damn, that was a good one. I wish I came up with that.
Steal it. All my best work is stolen. I'm sure
we're going to we're quoting you and putting you in our monthly newsletter with this one for sure.
Wonderful. I look forward to it. So the idea here is, let's think of put option protection as fire insurance on the house. And the question is, when you're buying that insurance, what actually goes into the value of that insurance? And there's two pieces. The first is, what is the actual damage to the house? So in theory, the more damaged the house is during a fire, the more valuable that contract becomes. The second is, what is the perception of risk that the house might burn down? So if there's a wet season and it's very unlikely for houses to catch fire from forest fires, then the protection is going to be pretty cheap to buy. But if it's a dry season and there's a huge risk that a lightning storm could trigger a fire that could light all the houses ablaze, the insurance company is going to say, no, we need to increase the amount of premium you pay because the probability of that happening is a lot higher. Right now, post 2020, the market is focused on the second and is saying, ooh, there's a huge perceived risk of downside. Everyone's buying protection. So that part of options is bid way up. And so now, even though the market is selling off, the house is catching fire. It's in line, or more or less in line with perceptions of the house, the probability of the house catching fire. So you're not getting any extra benefit of the perceived risk going higher. All you're really getting benefit from is the value of the contract of the house catching on fire. And so you're only getting sort of half the benefit.
Yeah. And then
it's a long way of saying, if you're in option speak, you're getting some of the delta, not a ton of the vega.
Right. Well, we could extend the metaphor and almost overlay implied versus realized sometimes too, and how it affects delta and gamma positioning. But also, I think about it too, is especially the expectation is based on what we call like the echo of volatility. Ever since like March of 2020, you have that sort of sell-off. Everybody has recency bias. So you have the expectations of people being fearful of house fires, which tends to that's why we've had VIX in that kind of mid to high 20s to low 30s range since March 2020. The other one I always try to bring up too is when we had the election in late 2020, you had vol was getting bid up huge because people once again were expectation of volatility, but that was because 4 years earlier a lot of them got burned on the Trump election. They had zero expectation of it, so it was recency bias, but it was 4 year prior recency bias. But when you have these one-off events, it's always interesting how that works. And I always thought about it because I used to trade options around earnings and that IV ramp around earnings. And it was always interesting if the previous earnings call outpaced the expectations, then volatility would be much higher into the next earning call. And then if it comes back down, it's just so much recency bias, which you wouldn't think would happen in markets, but there's just a ton of recency bias. And that's what like you said, we've seen this year is a lot of people have had that protection on.
Well, and it might not be irrational recency bias actually in the case of earnings. Like if you believe that earnings surprises are happening, then it might be a sign that analysts are not understanding what's actually happening within the underlying business or what's going on in the economy. And therefore, you might have a wider variance around sort of the expectations that the analysts are estimating. And just say, look, they weren't as good last time. They clearly are missing something. Why would I believe they're better this time? So it's not always irrational. I understand the recency bias aspect of it, but you could also just call it Bayesian updating, right? In a certain sense. But yeah, it's interesting. So look, part of
Bayesian updating is a fancy word for recency bias. And no,
one of them sounds irrational.
Mistakes, right? That's what I'm saying. And behavioral mistakes, exactly.
Yeah, one of them sounds fancy. One sounds like you're an idiot.
Yeah, exactly.
So when you do it's recency bias. When I do it,
it's a Bayesian update. Exactly. Right. So part of that though, to take us in the same direction, and we were bringing up OPEX, or option expiration today, and some of the estimates are upwards of just under $2 trillion of options that need to be rolled. And I won't bear the lead. I'll let you talk about what happens when dealers are positioned positive or negative gamma, and what happens if that's different from the upside to the downside. And that's why we were talking about maybe we see a flattening of those deltas. What recency bias, Bayesian updating, is in recent OPEX expirations, we've seen a flattening of those deltas and that mean reversion going into the end of the day. That's why we're saying we may see this face surfing rally. But maybe talk about some of the things you were checking in with some of the investment banks and where they thought dealer positioning was on the gamma front.
Yeah, so this is a huge options expiration and a particularly interesting one because a lot of the puts that are burning off are now in the money. And so it's a real question of, are these going to be rolled in a way that maintains the same negative delta exposure, or are people going to monetize and not roll? It's still a big open question. I got a research note from Goldman Sachs this morning that was estimating, and again, it's unknown how this is all going to play out, but that was basically estimating what we're going to see is positive gamma to the downside and negative gamma to the upside. Now, what does that mean? Well, it means to the upside, option dealers are going to be chasing prices. When you have negative gamma, if price goes up, that means that dealers need to buy to hedge. And if prices go down, they need to sell to hedge. So that could actually create some accelerated slippage to the upside, which ties into some other upside risks I see in the short term with other systematic players. But conversely, we are getting positive gamma on the downside, which tends to have an effect for dealers that when the market goes down, they need to buy. and when it goes up, they need to sell. And so it ends up having this potential pinning effect in the market and can actually further dampen volatility or prevent markets from falling as quickly, because you have this sort of counter cyclical effect. Every time the market drops, you're getting someone to step in and buy. So that's normally the reverse. In most markets we've seen in the last, call it 5-10 years, where dealers arguably became more influential in the amount of flow they have, that was the exact opposite picture, that the upside is where you had positive gamma and the downside is where you had negative gamma. After this expiration, it looks to be flipped the exact opposite, which could help support the market on the downside, prevent a sort of rapid sell-off, but again, could also send us upward really quickly, potentially.
Well, and you said something there that I think most people might be surprised by. You said upside risk. So can you find that? I think people are always worried about downside risk and people never think about upside risk. So what do you mean by upside risk?
Yeah, when I talk about the risk is to the upside, to me it means where are players positioned in the market that they would be offsides and have to cover quickly. So things that I'm seeing right now, fundamental long short hedge funds are significantly degrossed. They don't have a lot of leverage on, they don't have a lot of exposure. It looks like they've actually bought a lot of calls. So you can look at call option open interest in underlying stocks. It's actually gone up dramatically. It looks like they're trying to hedge the risk that the market rallies by buying out of the money call options. But you look at CTAs, for example, they're all net short equities. So if the market starts rallying, they're going to have to chase prices. If you look at target volatility strategies, they're largely delevered because equity volatility has been high enough. And so if the market rallies and volatility drops, they're going to be chasing prices upward. So there's a lot of these strategies that would be caught offsides by a quick upward move and would then contribute as buyers that could continue the move upwards. Versus if the market keeps selling off, most of these players are not going to be continued sellers. They've already sold all their exposure that they're going to sell. They're no longer putting significant marginal pressure to the downside. All their marginal pressure risk is to the upside.
I wonder when you brought up call option positioning, positioning, and people always say like if call option positioning is necessarily like a bullish positioning, but I always wonder sometimes if it's equity replacement, that's actually a bearish positioning because you're limiting your downside risk. So how do you ever know if like the call option buying is a bearish or a bullish call?
That's a great question. You sort of have to, right? I mean, people have models for this to see who is crossing the spread to get the deal done. I mean, that's, there's machine learning models that people try to look at that stuff. I think in this case, it was very explicitly equity replacement, but in the money equity replacement versus out of the money equity replacement is different in many senses, right? In the money call options, you could say it's the underlying plus a put. Out of the money is a little bit of a different gamble. Right. And I think what's happening, at least what I was seeing in this data, was that it was more out of the money exposure. And so they've taken off a lot of exposure because vol is high. They're getting whipped around in their long shorts. They're getting margin called on their shorts because all that stuff's going against them versus their longs, which have been underperforming. And so they're just saying we're cutting risk and we're replacing that risk. We don't want to be offsides if the market rallies. So we're going to buy some out of the money call options.
By the way, I saw in here before we get to like the next point you had in your newsletter, there was a question about like FOMC and raising rates, and that's not the not necessarily the stuff that we traffic in. But I always think it's interesting too. Is like if the market keeps selling off, we'll see how dramatically the FOMC changes their positioning about raising rates through the end of the year. And like that's your Bayesian update, right?
Yeah, and that was like I had 4 points in the newsletter. Sorry, I'm looking down because I want to actually pull this out. But you're
hitting on point one really well, like without even saying it. You kind of covered a lot of the things you talked about in point one in your newsletter.
Yeah, I make a lot of this up as I go. So there's really 4 points that I had in my capitulation checklist. All right. So the first point that I had in my capitulation check was significant and sudden degrossing and levered strategies. That's sort of impossible in this market environment. Almost all of those strategies have already degrossed. So it's hard to get like that waterfall capitulation. At least, that doesn't account for some structured products and other stuff like that. But at least for the major CTA risk parity target vol type strategies that I track, they've already sold off a ton of exposure. And so they're not going to be huge marginal pressures on the downside. The second that we typically see in oversold condition in capitulation environments is like a dramatic spike in oversold conditions. And this can be both technical and fundamental. So, for example, you could look at the number of stocks in the S&P 500 that are trading 25% below all-time highs or 52-week highs. You could look at it. I mean, I don't look at a lot of technical indicators, but things like RSI, how many are trading sub 30 RSI, and plot that over time. And if you look at that for both the NASDAQ and the S&P, we're not at dramatically oversold conditions under the hood. It seems to be limited to a smaller subset of stocks that have had most of the pain, but compared to a 2008 or 2020, there's still a lot more that could sell off to get to those oversold levels. And then when you talk about from a fundamental perspective, though, it starts to look very different, where you start to say, okay, is this oversold versus historical, quote unquote, fair value? And here on a cohort perspective, small, mid cap, and sort of large cap, excluding mega caps, actually all start to look pretty attractive. And this is sort of on a mix of forward-looking earnings as well as sort of trailing PE and that sort of stuff. If all those numbers are wrong, it's garbage in, garbage out. But it's interesting, again, it's like the mega caps look still dramatically overvalued. Mid and small caps do not when you start looking at relative historical valuations on a percentile basis.
No, I'm sure you're probably, the next part is like getting into the factors too, like where I think part of your newsletter was also talking about value. And we've seen a bit of a rally in value, but like, do you think that rally is going to extend, or is that part of the capitulation process? Is you like to see that rush to value first?
Yeah, value is a weird one. I don't consider value in and of itself necessarily to be like a capitulation signal, because in the 2000s, you got to move to value, but that was only because, in my opinion, value and quality sort of became the same thing, versus value got destroyed in 2008 because value was buying into financials, right? Like just a naive value strategy. So value in and of itself as a factor, you don't necessarily need to see that sort of flight, but you do in a capitulation tend to see a flight to safety, which is higher quality stocks, min vol, low beta, defensive names. That wasn't true. In fact, I invest in defensive styles in some of my mandates. They were dramatically underperforming the market through the end of Q1. It really wasn't until April that they started to catch a bid. And in May, they've sort of been flat-ish to neutral. So you're not seeing this huge flight to safety in your typical, quality minus junk type exposure either.
What do you think? Almost that's another recency bias too, is like in whatever worked in like 2008 to 2010 and defensive or whatever, wherever people, sought to position their books, is like when people are fearful again, those get bid up. And so that it may not provide the protection that it did over the last cycle. And we're using historical precedents to try to guess where, the defensive names are going to be. Do you think that's part of it as well?
Yes and no. I mean, if you buy a basket of lower beta stocks, just by definition, if the beta is a good estimate, they should go down less than the market.
If the beta is a good estimate.
If the beta is a good estimate, which isn't always true, right? You
right.
saw in March 2020 that was not the case for min vol and low beta stocks. So it's entirely possible that you don't get that sort of capitulation. That's why, I look at the checklist that I was sort of putting together as, you don't need to check every item, but these are things you typically see. You see the flight to safety. I mean, speaking of flight to safety, you are now seeing a decoupling between rates and equities over the last couple of days, which is interesting, right? We're seeing this jump to positive correlation due to inflation fears. Or at least that's my narrative for it. And now all of a sudden you're seeing equities down, rates up, and equities up, rates down, back to sort of how things used to be. An interesting argument about bringing back sort of the safety characteristics of treasuries, if people sort of believe that at least the 10-year rate is ballpark in the right area for inflation risks.
I'm thinking, sorry, it just jumped into my head too. Like you said, I was at Permissionless this week, and so was Captain Jack, and it was interesting. I was really curious to what the vibe was going to be like too, especially with what on with UST and everything. And, you know, everybody seemed to be positive. So I don't know, sometimes is that doesn't show capitulation, but also may show irrational hope. I'm not too certain of what those things show and how much that like even correlates to the TradFi markets.
No, I think the perfect example there is like, not to say people who are in Bitcoin are necessarily in ARK, but capitulation typically requires either levered players getting blown out, like force exited from the market, or just significant pain. And I think crypto folks are used to significant drawdowns. You look at ARK, you're still seeing dramatic inflows. People are still doing the buy the dip behavior, or they're just long-term religious converts to that style of investing, and they've accepted drawdown risk. And perhaps now they're arguing it's better value than it ever was before. But unlevered longs only really capitulate when the pain gets really bad. And one of the graphs I had, and I just put this out on Twitter, I don't know, maybe an hour or so ago, was Goldman Sachs had a great graph in one of their notes that was talking about the dollar-weighted average of the $1.3 trillion that's come into global equity markets since November 2020. And even though markets today are off by 20% from their all-time high, on a sort of that dollar-weighted basis, that money's only underwater by 5%. So the point there being that, yeah, you had this run up to high, and from a high watermark we're down, but from where people invested the dollar, now they're only 5% underwater. So the first 15 was like house money. And as much as you shouldn't think of it that way, people have that house money effect. We're now at the point that it's $1 money, and I think the sentiment potentially significantly changes from here.
And I think Jack beat me into it in the comments. Is like, I think you retweeted Balchunas' tweet about flows into ARK, that we're still seeing like record flows back into ARK. And so when, like you said, it's the BTFD moment, like as you had for a decade plus now, people are trained to buy the fucking dip. Is like, you know, what do you mark as capitulation to buy the fucking dip? Like when it's just those flows, is that what you'd be looking at?
Yeah, I'd probably be looking at the flows. You know, there's this interesting narrative that comes out that people are bad investors, that they always sell the most at the bottom. And I think the cause and effect is wrong there. I think it's the bottom because that's where people sell the most, right? The reason it's the bottom is because all the marginal buyers and all the marginal sellers at least blew out. They sold their positions, and that's the end. And therefore, buyers are now going to overwhelm sellers. You just, if you keep having people buy ARK, that's not capitulation, right? Capitulation is they all turn around and sell ARK to zero. And but that's when you probably want to buy.
Well, and as we never know exactly what's going on, as Michael pointed out, is like, are those flows due to shorting?
Are those flows due to shorting? It's a good question.
In ARK, that's what I'm saying. We, like, just like everything, like we were talking about dealer positioning, it kind of drives both of us nuts. Is like you said, you pinged all like the investment banks to see where they were saying dealer positioning flows are. There's all these other metrics online where dealer positioning is, but nobody knows for certain where dealer positioning is. If they did, I'm pretty sure they wouldn't be putting out a newsletter or selling it to you online. But so the same thing is like the flows into ARK is like, are these bullish or bearish? It's just like we talked about, is call option positioning bullish or bearish? Like it
no,
just...
so I'm thinking this through. I don't think it could be from shorting. I'm trying to think this through, unless dealers are creating to lend, which is, I guess, potentially possible, right? Because what's getting tracked with something like ARK is actual creates of the ETF. So if I wanted to borrow,
the block creates, is that what you're saying?
Yeah, if I wanted to borrow, the only way I think it shows up in the flow data like that, this isn't just volume, this is like actual creates, redeems of the underlying assets. I think the only way it would show up is if I went to borrow a huge amount in a deal, and basically an AP said, great, I'll sell it to you, or I'll lend it to you, and then the dealer is ultimately going to have to then go create that unit, which would look like flow. But then the dealer has to hedge that out. And the question is, how are they going to hedge it? So it's a great question, Michael. It's entirely possible, and I'd have to dig a little bit deeper into sort of maybe where that flow is coming from.
And you and I are trying to get better about defining our terms. So when we're talking about create redeem for the APs, they're market makers that are creating and redeeming ETFs or different positions, and part of that is like they're usually in 25,000 or 50,000 unit chunks, right? Is for the create redeem. And do you know what the number is for ARK? I don't even know if it's 25 or 50K or
I don't
something
know.
Like that.
And it's normally what happens is if you want to create a new share of the ETF, the market maker buys up the underlying basket, goes to ARK, says, here's the basket of underlying that you want to own, and ARK gives them a share, and then the market maker can go sell that share. The way law is codified, the market makers can actually, I believe, sell that share before they've even done the create. Market makers sort of have a weird, like time vortex in the world of market makers that they to facilitate markets, they can do those creates after they've sold.
All right, we were up to. Did we get through number 3 on your newsletter for?
So let's go through. So point 1 was significant and sudden degrossing in levered strategies. Point 2 was a sudden spike in oversold conditions. Point 3 was we typically see a spike in cross asset correlations, right? And this is because, again, forced degrossing. You get these days where it's like, and you saw this in 2020, you saw it in late 2008. It's like stocks down, gold down, treasuries down, just everything gets sold for cash because it's forced, margin calls. And there, I didn't have a great graph other than to say, like, you typically see a big VIX spike during those periods. And again, we're not seeing the VIX spike right now, though. Even in those days, like, vol can sometimes sell off too. Mm-hmm. And then the last one, which you sort of started to talk about, is in my opinion what you've seen historically, and you may not see this time, is the Fed steps in with either guidance or action. And I think the Fed has made it very clear that they are going to play chicken between inflation and unemployment at this point, that they want to get inflation under control. They are being very clear in their guidance, and they're basically saying, we're going to let the market play as it does until it gets to a point where our two mandates are in conflict with each other, and we need to pick the bigger risk.
The bigger, like, I think, historically, we're not going to get into macro because we always get ripped for that. But by the way, I love Jack putting on macro.
There's no way we're not getting ripped for it already. Right. And we've gone too far.
Historical precedents would show that market sell-offs tend to bring down wealth inequality more than almost anything else. But sometimes if that gets pushed through, I think part of what you were writing on another note it was the same newsletter today. Maybe on your note, you were talking about what we discussed on the show previously about the idea of what the bubble ballooning and bursting from pre-COVID to post-COVID, and then does that get manifest and pushed out in inflation? And then everybody tends to get upset about what inflation does, both domestically and globally. And we're empathetic and sympathetic to that, but also at the same time, I think Jeff Curry has talked about a lot recently that, in his opinion, inflation is actually what reduces the wealth gap as well, because it punishes savers, and then inflation and price spiral tends to go towards the lower income, as both they're competing to buy those commodities and those resources, but they're also, the money's flowing to them that's running up the prices, and the people that historically that were savers, their money's getting inflated away. And so maybe it's not even just market crashes, it's also inflation that tends to reset like wealth inequality. And I just basically set you up to just get ripped no matter what you say to, or in response to that.
No comment, pass. I know better than to wade into this territory, Jason. Look, I stole the idea from you and I put it in my newsletter, and I'm claiming it as my own now. I blamed it on you on Twitter, but in my newsletter, I even came up with a name for it where I said it's warping economic space-time. That's what monetary and fiscal policy perhaps did here. Warped economic space-time to keep us from going into a massive economic contraction due to COVID, and is now going to do a prolonged, potentially bear market in assets, mild recession and contraction in GDP, with heightened inflation risk, right? Risk is never destroyed. It's only transformed. We ended up having such massive policy that perhaps we pushed the risks into the future and transformed the nature of them. And now we're dealing with that fallout. I'm not making a statement about whether that's good or bad. I am going nowhere near that.
And by the way, I think I'm going to even go with, it was a misrepresentation of a private discussion you and I had, but then you pinned it on me on Twitter to start this
of course,
this rage. No, it was well played. It was
Of course. That's what private discussions are for.
And then I can't necessarily defend myself on Twitter. It's like, when did you stop beating your wife?
Okay. The other thing, so I didn't add this in my capitulation. I'm just moving past that. The other thing I didn't add in my capitulation checklist, but you also tend to see towards market bottoms, is firms shutting down. Or funds blowing up. So in March 2020, there was a day I remember tracking mortgage REITs where UBS shut down 2 mortgage REIT ETNs that were 2 times levered ETNs and basically just sold off instantaneously $4 billion of mortgage REIT exposure. That drove mortgage REITs way down that day. That's the type of stuff you tend to see. You don't always hear about the hedge funds blowing up in real time, but you can often see it in mutual fund NAVs, what's happening, or ETF NAVs. I'm not seeing much of that right now. I'm not hearing about funds shutting down. Melvin did just shut down, but that was happening. That was a slow motion train wreck.
Exactly.
There was a famous shorter that did shut down right in December, and someone I blank on who it was. Someone on Twitter was like, "This is it. This is the top," and it was almost like to the day the top. But it was a short seller that.
I think some people were hinting at it on Twitter today, but other people were like, "What evidence do you have?" Like we were talking about like the very beginning. It's been a fairly orderly kind of sell off. I mean, have you seen anything that would give you pause to think that actually there are?
Yes, there's one fund. Hold on one second. I'm going to tell you right now what it is because I was talking with some friends about this. It is, I hate naming funds, Alpha-Centric Income Opportunities. The Alpha-Centric Income Opportunities Fund was having a gangbuster returns pre-COVID and then absolutely blew up during COVID and then somehow managed to be the phoenix rising from the ashes. I don't think you could have bought a better fund at the bottom and had better straight line up returns. That is now rolling over again. So there's something very illiquid and dangerous going on in what they're buying. So you sort of wonder, what are the knock-on effects elsewhere? You're starting to see, credit spreads and CDX blow out. I think CDX, high yield CDX rates are now at sort of 2018 levels, which is interesting. So you're starting to see things get priced in from a risk perspective into the credit market. No, again, nowhere near 2020, and I'm not seeing anything else blow up on the fund side. Saw some long short funds get whacked, but that's sort of, again, that's been par for the course for stuff that was super long, innovative tech and short quality. That trade reversed violently. And so it's not so much they blew up, they just more round tripped. They had a great 2020, 2021, and 2022 has been a disaster.
Fair enough. And for those playing along at home, it looks like so far we're flattening the deltas going to the close, but those last few minutes can be wet and wild today. But like so far, it's coming back in a little bit. But we'll kind of see what happens. I kind of want to. I'm trying to think of what I can say publicly. By the way, Menichem was right. Like, I'm trying my best to avoid the comment section, and I feel like now I know what it's like when I would watch Resolve Riffs and I would put in the comments just trying to make Rodrigo laugh, and then watch his face for the delayed reaction. I mean, Menichem's put some just bombs in there that are like I'm trying not to pay attention to. But as you know, our comment section is hilarious at times. He's talking about the market actually getting pegged. Okay. So yeah, exactly. So trying to avoid the comment section, but trying to think of what I could say publicly. I'll use toy models. So I was just, before we got on, I was talking to our mutual friend Hari Krishnan, and we were just talking about where the markets were at today, what's going to happen through the end of the day, what you should do with positioning. And let's just use a toy model. Let's say, for example, you were buying like weekly put options, right? At the end, going into close today, do you monetize pre-close, or do you take delivery of the futures and then you're open to a face ripping rally over the weekend? Or do you, monetize, and then buy the next week, say you're trying to do short term. So you monetize that position, then you spend a bunch of that premium because Vol didn't really raise that much on the IV side, but then you buy maybe next Friday, for example. So you roll that, but you're losing some of that P&L that you just created. Or like you said, you take delivery of those futures. So now you're, you got those Delta One shorts on, but now you're open on the weekend to get your face ripped off to the upside. So maybe you buy a few calls as protection. But what I'm saying is, like, I'm not sure there's a good answer. So we're kind of like just walking through all those different scenarios. And I guess it really depends on your mandate. But I'm just curious what your thoughts would be.
Well, why are you taking delivery of the futures and then keeping them on? Like, why? Like, is the point there that you want the negative exposure over the weekend because because the whole point is you want the protection?
You want to keep your protection on. So your mandate is to have, like a protection on, like you're a long vol or tail risk fund, and primarily using options. But then you could take delivery on the futures, and then you'd have a much closer to Delta One short, depending on how much position you had on versus your notional. But then so you're holding over the weekend into the next week or however long you want to hold them. You're now have that more structural Delta One position on, and so therefore do you want to but then if the market rallies, now you're going to you don't have that non-recourse leverage that you had with buying the put options, and you can get you got that Delta One to the upside too. So you could lose a lot of what you just made this week, assuming the market doesn't flatten into the close here.
Yeah, I mean, I think this goes back to the question of what is your mandate, what is this getting paired with, and how big is the size, right? Like there are cases where if you want to monetize, but you want to partially monetize, right? You could say, okay, I'm going to take delivery, but also buy back some futures, right? So I'm taking my total delta of that position down. I do like the idea, though, if you are taking delivery, to buy those cheap out of the money call options to sort of cap that exposure, right? Because I guess what you could do is, again, sort of synthetically replicate with the underlying plus the call what the put position that you want to have on sort of could structurally look like. So there's ways to do that. I guess I would just say, if you know the position you want, why wouldn't you just take that position? And so I think your question is, what happens when you don't know what position you want? Because all of these things have path dependent trade-offs, right? You want that Delta One totally naked, or Delta negative one totally naked if the market tanks over the weekend, but you're taking huge risk, uncapped risk to the upside. So do you cap it with the call options? Well, what if the market just sort of rallies a little? Well, would you have better off monetizing some of that put and rolling to a lower delta put and have less exposure and maybe more vega? These are the things that you deal with, and it's all path dependency. And when you're talking about options or any convex instrument, it's the worst form of path dependency.
Yeah, and we're not even talking about the different pricing of those different options, whether like you're like saying buying the calls as the hedge or rolling to the next week or taking the future. Like there's trade-offs. So even though you're trying to monetize some P&L this week or even today, these are the trade-offs, right? And I'm not even talking about the pricing because then we start getting into a bit of 3D chess there. But I just wanted to point that out to watch you kind of work through it too, as I just kind of brought it up. Is like that's the idea, is like not only because you and I don't necessarily take naked direction either way. And so therefore, like you're always going to be losing some of that P&L to hedge across the other position. So even if you were, like you're saying, Delta -1, you're still going to hedge to the upside too. So you're going to reduce that P&L exposure. You're going to use it to roll into over the weekend or into the next week. And I think it's just interesting to kind of walk through that to show like how dynamic this can be. And even with a specific mandate, it's very hard. And so without one, it's even harder.
Yeah, with a specific mandate, it can be really hard. And again, it very much depends on what else you're doing with the rest of your portfolio and how that mandate is supposed to fit with the rest of the portfolio. These are very non-trivial decisions. I mean, from discussions we had last week, I was wrestling with this last Friday going into the weekend, where I was getting towards some monetization targets, and then you're about to take sort of 48-hour risk. Right, of a lot of things can happen over the weekend that you don't get a chance to trade. Do I want to monetize? Do I not? Do I want to partially monetize? And so to me, a lot of the decision is a mix between what's the mandate, probably primarily, that's the most important. What is this position supposed to be doing for you? And then what is the path dependency of the most pain? And can you figure out a way to potentially come up with something that keeps you as much in mandate as possible, but hedges that path of most pain as cheaply as possible? And if you can do that, I think you're in a good position.
Yeah, and part of it too is and I know you and I discuss this often too, is like that Bayesian update or recency bias is like this morning when you saw the market down 2% and you know it's OPEX and it's a Friday and like just for like the last several OPEX cycles, you've seen the flatten the deltas and the market mean revert. So you almost want it, you're like, should I monetize here? Is this the bottom at like 11 a.m.? But like what you don't know is like people can get lulled into a false sense of security where even if it happens in the last 8 OPEX cycles, there's nothing to say it can't go from -2 to -8 pretty quickly through the end of the day. And even if dealer is positive gamma position, doesn't mean you can't break through an inflection point. Like it's just anything can kind of happen.
Well, I think Jem Carson, a mutual friend of both of ours, had a great note. I think this was his Q4 2021 investor letter. Kai Volatility is his firm, where he talked about his view was the market was going to have a grind lower in 2022. Vol was not going to provide protection, and that what was going to happen is that people were going to have to get sort of frustrated with their vol position and monetize earlier and earlier and basically put on less protection to the point where then they were underprotected so that the market could sell off violently and that they would be forced to buy puts driving vol up, and that would sort of be the capitulation event in his view. And so to that point, right, we keep having this scenario where the market sells off a little and then rallies and then sells off a little, and you're not getting these big spikes in vol. And so I think people to that recency bias are going, wow, it's actually been really beneficial to like maybe just have some put spreads on, play the delta, not the vega, monetize these things earlier in their life, take that, bounce back bear market rally guess. And I think the more that happens, the more likely you are to see the violent sell-off after everyone does it, because the protection won't be there anymore. And again, I think the way to think about this is everyone has put protection on when they are there for becoming the natural buyers during a sell-off. Like if everyone is hedged, or you have a lot of people like long short funds when they're out in the market, they become the natural buyers when markets sell off. If there is no hedging, there's no natural buyers anymore. And so that's where the risk sort of comes in for like that last leg down capitulation. And by the way, even though we're talking about capitulation today, there's no reason we have to see a capitulation. Like I don't really feel like 2015, 2016, that sort of double bottom ever had a capitulation that I can remember. So there's no reason that this could not be the bottom and we could rally for the rest of the year. I'm not saying it, but when I am looking for like that flush out capitulation, these are the things I'm typically looking for.
Yeah, there's just so many things you said in there I want to pull on. One is like, that's the old trader trope that a hedge market doesn't crash. Like that's what Jem's talking about and everything. But then I like a lot of long vol and tail risk managers tend to disagree. And maybe sometimes even, I don't want to speak for him, but like Chris Sidio would talk about there's inflection points, right? And even though you might have a hedge market, if you break through that inflection point, then there's an air pocket after that. So even though you may be bouncing and mean reverting and like that whole, Panther clone 70% of the time works all the time until it doesn't, right? And that's part of like, or like the Fed put, people like to say, just because people say those things or a hedge market doesn't crash doesn't mean you can't break through that. So if you're mandated to protect against those sorts of things, you can't take that positioning off just because the rest of the market might be hedged. And I think that whether it's Jem or a lot of other people, and you and I think even were talking about this, whether publicly or privately over the last couple of years, is like the pain trade, given where everybody's positioned over the last like year or so, has been that slow grind down that we've seen this year, right? Because no matter where your positioning is, because vol was bid up a little bit, so even like long vol tail risk can't necessarily do well in these sorts of scenarios. And so, luckily on the other side of that, a lot of the CTA trend advisors have done well in this kind of environment. But like that was the general pain trade for most people, was a slow grinding down market. And then, like you said, then the protection doesn't pay off. So maybe that's number 5 on your capitulation, is when we have the buy the dip dynamics just keep you reinforced. It keeps working out for people. And then on the dips, even if we get a bigger dip like we've been seeing in this month, then people their volatility or tail risk doesn't pay off. So they say, screw this, it doesn't work, I don't want to be hedged anymore. And then once people are just naked long and those hedges are completely off, maybe that's number 5 on your capitulation index, is like, if people are no longer hedged and everybody's long or levered long because they don't think hedging works anymore, but it takes time for that to like work through the system.
Yeah, weirdly enough, it might be that the market goes lower and vol goes lower, right? You'd see that spot down, vol down dynamic that I think most people don't expect to see, but that could be just people saying we're not doing hedging anymore. I don't know if we're going to see that. I mean, institutionally, I keep seeing that employee retirement systems around the US are increasing their tail hedge mandates. I just think it's that rear view 2020. No one wants to live that again. So it makes it hard for that environment to ever occur because everyone's fighting the last battle. I will say you pointed out sort of the pain trade was the long grind down. If this ends up being a year of down 25, down 30, down 40, and it's a slow grind down the entire time, this will be like, at least in my echo chamber, the most accurately called year ever. I can't remember a time in my career that so many people said the pain trade is a slow grind down. The market's overvalued. That's what's going to happen this year. And it seems to just be playing out that way. And it's sort of mind-boggling to me. And again, I always wonder what would 2008 have really been like if FinTwit were the same way it is today. I just think it's a totally different social environment. And you can't really compare sentiment today to how it was in 2020 versus how it would have been in or felt in 2008. People calling bottoms the whole time. Okay, wait. This is also a podcast. We need to explain what's going on to people who are just listening. So Jason right now is in Chicago. He's recording at the courtesy of Jeff Malik of the Derivative Podcast. Great podcast. Everyone should go listen to it. And Jeff just shout out. Jeff just walked in the background in full pirate regalia behind Jason.
Oh my god,
that one really caught me off guard. Was not expecting. Well played, Jeff. Well played.
The full mutiny on the Pirates of Finance. Yeah, once again, shout out to Jeff Malik, the Derivative Podcast, RCM. Check it out. I think people were asking him also about the Star Wars Guide to Investing in the background. Jeff's a huge Star Wars fan, and so he does all these posters with like the Jedis of Volatility, etc. Who has that on deck?
I was just thinking about that. Like, where did that come from?
Exactly.
Oh, that's impressive. So back to the point at hand, though. Like, how many people last year said the path of most pain is a slow grind down to you? I feel like that was just my entire echo chamber to the point that I became convinced it couldn't happen. I just got so contrarian because I was like, everyone thinks this is the trade, and it seems to actually have played out that way.
Well, I think
so far,
we're definitely in a echo chamber. So I don't know like broadly like what it was like, but I know you and I were talking about it often, and quite frankly, we were talking about it often because of where our positioning was. So we knew it was kind of a pain trade for our books a little bit. So that's why we were maybe talking about it a lot, and that's why the people in our circle were talking about it a lot. But also, I want to touch on another thing. What I noticed we like to do is instead of giving our hot global macro takes, we like to quote all of our friends, and we probably misquote them and put words in their mouth. No. But when you were talking about like institutional tail risk hedging, it reminds me of our good buddy Ben Eifert also talks about large real money institutions. They're like massive cargo ships, right? They don't really turn very quickly. So it takes years for them to put on positions, then get fully levered into positions, and then wait years for it to not be working before it takes them years to pull it off. And so like we're talking about the echo of volatility, like everybody wants insurance after the flood. And so a lot of these institutions will come in, post 2008, post March 2020, and they start putting on those tail risk hedges, and they're putting those on for maybe years until, like you're saying, they don't play out. It takes them years to think they're not going to play out. And so they start unwinding them all until we get to so this is almost like a 10-year cycle till we get to where we were in March of 2020, where like CalPERS, everybody's taking off their hedges and all those hedges are gone. And then that's when the market crashes again. So it's like, it's this counter-cyclical like positioning you get from these real money institutions because they're enormous cargo ships.
2008 was the exact same way, right? That they all started diving into trend following strategies. They all started diving into tail risk protection. And it was really post 2008 selling vol was probably the better strategy. Like equity replacement selling puts was probably maybe one of the most attractive strategies you could have had at that time. But try selling that to a real money institution that just got absolutely blown up in 2008. Telling them to sell vol probably wasn't that attractive to them.
Right. And then how many people, were like selling well in 2010 because those spreads got so blown out, but those were more smaller players. Those weren't the institutions. So it's like that counter cyclicality can play both ways depending on what size you are.
Can I totally change the subject? Pensions
Please.
made me think of this Allianz situation.
Yeah.
The Allianz Structured Alpha Fund.
You mean just lying?
So this Allianz Structured Alpha Fund, if you haven't looked up the news, look up the news here. But they got in trouble in March 2020, and I thought the news had fully come out, but the SEC's indictment against them is just mind-blowing, the level of fraud that was going on at this firm. And it was brazen fraud. Like, these guys were emailing each other instructions on how to lie to clients and manipulate numbers that they were providing. And I will point out that all of these emails are archived for 7 years for compliance reasons. Right? It wasn't like they were texting each other and trying to circumvent compliance. This is all in their archived system. To the point where they were saying to each other, oh, if we change those numbers, that's worth $1 million of comp to us, because their comp was tied to the risk level performance of the strategy. So they were smoothing performance numbers to increase their comp and then emailing each other about it.
Unbelievable. I mean, it's just unbelievable. And their whole shock test system, like I was saying, lies they were just putting out blatant lies on like what their shock test and what the portfolio return should look like. But also, people should take shock tests with a grain of salt, because also it's just, once again, fighting last battle, recency bias, and no shock test is accurate because you don't know what the market environment's going to look like. By the way, it reminds me, after this, I got to show you some structured products I was looking at today, where it's like you got to participate like 120 to 150% on the upside, and on the downside, you were fully protected. You made money on the downside too. So it's like you made money both ways. I can't wait to see this.
So I was looking at, someone sent me one of those in my DM on Twitter and said, I don't understand this payoff graph. How can I be protected on the downside and make extra money on the upside?
Yeah, uncapped. It was uncapped on the upside even. Like usually you have a cap in there, right?
And I said that payoff profile is what you would call an arbitrage. So let's dig through the footnotes. And where it came in is the footnotes way down below had all the sales costs. And the sales costs added up to like 10%. I said, that's where it is. It's showing you a payoff profile on the 1-to-1 line. Subtract 10% from all of that. And that's how you're getting this payoff profile. It's not actually an arbitrage. You don't win in all conditions. You lose in these conditions once you subtract 10%. But I'm actually blown away that the SEC, actually, I don't know who governs those. Is it the SEC or FINRA? I think it might be the SEC. I think the SEC governs structured products. I'm blown away the SEC allows that style of payoff graph to be in the prospectus of those documents without subtracting out the sales charge.
But even subtracting out the sales charge on this one, it was pretty amazing. It didn't have a capped upside. And then the downside was like, if the S&P is down 20, you're up 20. It's just like, what?
Dig to the sales charge.
I haven't been able to look at it.
That's exactly how the banks are charging the premium, right? I mean, it's all options. That's all structured with options. Well, how are you paying for the options? Well, it's in the sales charge, not in the payoff profile. Well,
but that's what I was saying. Usually those insurance collar options where they have those like amazing payouts where you don't participate in the downside, but you have capped upside. Usually that's the rub. And
yeah, I've been seeing a lot more of those like 1.5 times upside, cap downside products that just look, like free money.
And by the way, so during our show today, well, it's come back a little bit. The market had rallied over 1% going into the close, and
it was up 1%, like positive.
No, it came back. We started, I think, down about right when we started the show. I think it was negative 1.7%. And at one point we were negative 20 bips. Now it's about negative 30 bips.
Wow.
So
options expiration, baby.
Flattening those deltas. So now we know next time they're only going to flatten the deltas. So
that's right. That's right. We'll use that for next month.
Definitely going to be in mean reversion environment. So for all of you that tune in and can't stand Corey and I blabbering on, and you're really here for Captain Jack. Captain Jack did a heroic effort just to make sure he could record this from an undisclosed hotel room before he catches a flight to wherever Captain Jack lives. So we appreciate his help and doing this at a regularly scheduled time. He tried to, make it more convenient for him, but Corey and I said, hell no, you're gonna miss your flight if that's what it takes to make sure you record at our regular scheduled time on a regularly scheduled channel. So we thank you all for tuning in. Once again, the comment section was amazing. One of these days, we're going to have to do an AMA from the comments channel, although I might get, non they might have a compliance issue. But other than that, make sure you subscribe to Blockworks. Follow Corey on Twitter. He's just at Corey on Twitter. I'm just joking. Like, I wish, wouldn't that be great if you had just.
I wish I had Corey. Yeah, that'd be great.
So he's at Hoffstein. I'm at Jason Mutiny. Jack is at Jack Farley 96. Because Jack was born in 2006. People don't know that.
Follow Blockworks, subscribe to this channel, hit like, share us with your friends, add comments, tell us what you think.
And we look forward to seeing you all next week. Appreciate it.